headline CPI and core CPI have come down from their peaks, but they seem to have kind of stalled out. The Atlanta Fed has an underlying inflation dashboard that shows a bunch of other measures of inflation, and a lot of those are worse now than they were a year ago. So has the Fed done enough?
Well, first of all, thanks for being here. It's really good to have Bloomberg as an attendee at our conference. This is a really good group, and your team really contributes a lot to that. When I think about the trajectory of inflation, I think that we've made a really good progress on that. If you think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen. We're not at the 9 and 10% levels. We're in 4.5 to 5 range. Now, look, that's still two times what our target is. So there's still a ways to go. But I do think that we've seen a lot of some of the froth really come out of the inflation measure. One of the things I look at, one of the measures I try to keep track of, is the number of goods in the basket of this that's used to calculate the CPI that are showing inflation above 5%. Right now, in the latest report, that came under 50%. Less than half now are in that range, or at one point it was 70 or 80%. So I think we're seeing that breadth narrow, and that's a really positive sign. So I think we are starting to see our policies really work.
But do you rule out any more additional rate increases?
No, oh no. Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. Look, I think we are in a place now where we've been in restrictive territory for something like 6 to 8 months. That's about the time you'd expect to see our policies start to bind on the economy. And when I talk to businesses, they tell me they're starting to feel that bind, and that's a really positive thing. But as you know, we've had surprise after surprise after surprise over the last few years, and most of them have been to the negative when it comes to getting closer to our inflation target. So I've got to keep that on the table for sure. But right now, I'm feeling like let's see how our restrictive policy is working, and that'll give me a sense of what our next move needs to be.
Well, you still have a PCE inflation report and a CPI.
We got 2 more, exactly.
Before your next meeting. What are you thinking now, though, for the June meeting?
Well, if I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on. But again, the folks I'm talking to, the businesses across the 6th district, and even in our survey responses, they're all telling us that there is a lot of slowdown that is on the way. And that really gives me some comfort that we're kind of in a place where we can let that play out, and then we'll see what we need to do at that point.
We are speaking with Raphael Bostic, the president of the Atlanta Federal Reserve. You're talking about what the businesses are telling you. What are they saying about their pricing power and their plans to use it or not be able to?
So, it's really interesting. Through most of the pandemic, our business contacts have said, if we needed to raise prices because our costs for input were going up, they could just pass that through, and the consumers were accepting that. I'm hearing much, much less of that now, and many of the businesses and the people in the marketplace are telling me they're pretty much at the limit, and their ability to continue to raise prices and pass through those higher costs is far degraded, in part because consumers have become a lot more price sensitive, which again I think these are the things that we'd want to see if we were getting to a place where the economy was moving back to balance, which then would get us to that 2% target. So pricing power is not nearly as clear and as ruthless as it has been. I think that's really positive development.
What about on the employment side? Fed forecast that 500 basis points of tightening should be raising the unemployment rate. Instead, it's gone down. What are they saying about their plans for labor?
Well, I would say 2 things on this. So first, everyone is telling me that their labor market experiences, their ability to hire, and their turnover internal to their businesses is far better than it was last summer. Now, it's still elevated and tougher than it was before, but there has been progress made. The second piece to this, though, is that we just came through a pandemic where many families are thinking about how they're going to work. Many employees are thinking, like, what is my connection to the labor market? We had all these retirements, so there's a lot of churn that's happening. I think that's contributed to some of the historically low unemployment numbers that we've seen.
If I can use a phrase you're not allowed to use in economics, is this time different in the sense that it was so hard for companies to hire coming out of the pandemic that this time they're going to hoard labor and we may not see the kind of unemployment rates that you forecast?
Well, I am hearing that businesses are saying, we don't want to let some of our best people go because it may be very difficult to get them back. I am definitely hearing that, but I'm mindful for how you started this. Every time there's a declaration that this time is totally different, it winds up not being totally different. So we're going to just keep our eyes open, my eyes open and our team. We're going to be out there really trying to understand where things stand. I do think the pandemic is triggering some real structural changes that it's going to take a while for us to understand those things, but we're going to have to understand those before I'll be willing to make any declaration that the old laws of labor markets don't apply.
I want to follow up on that in a second, but first let me ask you about banks, because there's been a lot of talk about that. Banks always tighten credit standards when the Fed is raising interest rates, and loan demand always falls. So the real question is, are you seeing anything or do you anticipate anything that would be worse than normal in terms of credit?
That's a good question. So, look, as you noted, when we raise interest rates at the Federal Reserve, we expect loan conditions and lending conditions to tighten. That has happened. That I usually don't want it to happen in such as volatile a way as it has with the Silicon Valley Bank challenge and other things. But a lot of this is going as expected, as I expected it would. Now the question is it going to accelerate? Is it going to stay where it is, or is it going to slow down? The bankers that I talk to tell me that the rise of liquidity risk as something that's really on their radar screen has caused them to want to be more conservative in terms of their willingness and desire to lend. But I'm not hearing right now that they've gone into a hyper mode where we really have something that I would characterize as a credit crunch. We're not there today, and I'll be monitoring to see if we get closer to something like that.
The Fed has sketched out a sort of backward-looking monetary policy framework, and that you're looking at inflation numbers for, quote, a clear and convincing evidence that the price level is coming down. Is it time to switch to a more forward-looking kind of policy to find indicators that tell you what's going to happen rather than what has?
Well, I would say we've always done both, right? So we definitely want to see what the official numbers are saying, but through our regional economic information network, we are talking to businesses all the time. Through our surveys, we have a pretty robust survey shop, and we're talking to businesses, and we get feedback from businesses in those cases. And some of the questions we ask are, as you're setting wages moving forward, are you doing that as a catch-up because your workers feel like they're falling behind, or are you doing that because you think that pricing is going to be where you need to do that? Today, what businesses are telling us is that they're in catch-up mode. Their employees know that their wages have fallen behind inflation, and to keep them, they feel like they've got to allow that catch-up to happen. But we are also, and that to me, that's a very positive thing, because it says it's reactive and not proactive. And as long as we stay in that environment, I think the probability that we get inflation to continue to recede is very positive.
Now, you've said, and most of your colleagues have said, that you anticipate keeping rates where they are, at least through the end of this year, possibly into next year. Is there any circumstance under which you think you would change that view if inflation came down quickly, or if the economy sort of fell apart?
Well, of those two scenarios, I would be more inclined to change if inflation came down quickly. Look, inflation is high, it's too high. We've got to get this back to our 2% target. If we do not do that, inflation expectations change, and you might get into this cycle where it becomes very, very difficult to get back down to a reasonable level. And that has all kinds of bad implications for families, for investment, for businesses, and for the country. So we've got to get that under control. the scenario for me of a rate cut, which I don't think is what's going to happen, is that inflation really starts to come down robustly through the course of this year. My models and my team and my outlook really tell me that I'm expecting to be in the mid to high threes by the end of this year, and that's still quite a ways from 2%. If I was wrong and inflation was much lower than that, then there would be a conversation on it. But I think right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me at the current moment.
All right, I have a left field question for you because this just came up in the last 24 to 48 hours. The state of Florida banning the use of a central bank digital currency. As the monetary overseer for the state of Florida from your Atlanta office, does that make any sense to you?
I have not been in any conversations to know what's motivated that. We at the Federal Reserve have done some study of this. We had a white paper, lots of questions. It's something we're mulling. I don't think something like that is imminent, but I don't know. Maybe they know something I don't. But I'm not really having a lot of conversation on that.